Okay, so let's understand the current solution for the given case. First of all, we will write our basic accounting equation, and from there we will start our main solution. Okay, let's say we are very willing to deal in the business of selling mm, selling clothes to our customer. Okay, into mainly textile business, but at a retail level. So I do not have sufficient money to start the business. So what will I do? I will go to the investors, I will go to my relatives, I will go to my friends to raise the capital, to raise the to finance, to fund my business purpose. Okay. So what happens? An asset is an amount. The asset is what are the elements? First of all, I'm talking about them. Then we'll move to the solution. Under assets, those amounts which are recoverable from anyone else, such as customers, depositors with whom we have deposited our money, or the persons to whom we have advanced some of our cash reserves. Okay, those recoverable amounts will be included in our assets. And most importantly, cash and bank balance. Cash and bank balances. Plus, why I'm writing plus? There is nothing to get confused about it. It is just I'm trying to notate something else before writing anything. Okay, cash, bank balance plus tangible assets. Now what are tangible assets? Let me show you. If I have to produce some clothes to sell to our customers, we will have machines to produce clothes. We have testing machine, so that we can know that what type of quality of cloth we are producing right now. Okay, so these are the items we will be listing under the term assets. In contrast to the assets, the liabilities are in contrast to assets. Okay, in contrast to recoverable amounts, liability payable amounts are considered in the liabilities asset side. So there is no contrast against cash and bank balance. Okay, but I can write very precisely. There is short and long term debt. Like you take loan to purchase the house. Okay, your vehicles, to purchase any type of property, like that. So these amounts which are payable after a certain period of time will be included in liabilities. Like it is the amount you have to pay to someone for the benefits you have availed. Okay, now what is the term equity? It includes capital raised, profit or loss earned. What is the meaning of capital raised? I will tell you very shortly. Okay, so capital raised means what what amount of finance you have raised through internally or externally, through from within the organization or from outside the organization. That amount will be considered in equity. Or we can also say we will include our profit and loss earned during the period in equity component. We can also equity is also known as, you can write it down what I'm writing here. Okay, take away from business after paying all liabilities. Okay, I am asking to write you down all of this. Why? Because this becomes easier when you revise for your exams also. Okay, so these are the terms. Okay, now let's move to our main solution. What is our main solution? First of all, we will draw our basic equation. In exams also, wherever you go, in most of the accounting concepts, you will face accounting question as your complementary topic to help you throughout the subject. Okay, now the question is asking us, what will be the effect of issuing stocks? Okay, issuing capital, issuing stocks in exchange for assets. First of all, I will draw a diagram for you so that you will be able to understand it better. So let's say suppose we have XN company, okay, willing to start new clothing business. Okay, but short of funds as of now. So it will go to A company, and X company says that that X company says to A company that X company will give shares of X company to A company. Okay, and in return, what A has to do? A will give assets to X company to fund the business purpose. Okay, this is very this transaction is very known to you, that what's happening here in the red line, the A company is giving assets to X company, so that assets in terms of, we can say, cash, bank balance, machinery to start the new business. Okay, but what the X company is giving to A, shares of X company to A company, these are the ownership of issuing company to financing company. We will understand the shares, the term shares, the term capital, the term preference share capital, and like other terms in later future when we will face much detailed problem. But just understand for the sake of this solution that X is issuing, we can say, 10% ownership of itself of X company to A company, and in exchange, X company is receiving assets from A company to start the project. That's all. Okay, so they will be increase in asset side. Why that so? Because here the A company is giving assets to X company. Okay, so they will be increase in assets. Let's say $1,000. Okay, so there are no liabilities. Why that so? Because there is no recoverable or payable amounts. However, as I have stated here, that whatever the capital raised, whatever the finance you will raised, you will include that amount here well also, as well also. Okay, so you will include $1,000 here also. So you have raised the capital to the extent of $1,000 from a company. You have received assets from a company to the extent of $1,000. So there are both side increase. Okay, now let's form the solution. If there are both side increase, so the correct choice, just if you have understood this transaction, if you have understood this transaction, then it would not have been much difficult to understand this calculation which I have just explained. I am taking $1,000 just as an example. You will, you can think it like this also. Like we have received asset side as plus, like we have received assets, so we'll make an addition to the assets. Here we have, so and here we have issued shares or issued the ownership of our company to someone else like a company. So we will also issue, so we'll also make an addition to the equity also. That is why there is both side increase. Okay, so the correct choice for problem 28 is A. Thank you.